Okay, awesome. Thanks.
Okay.
Awesome.
Fantastic. So to the men and women who cry to Adele's album, Karibuni, thank you for having me in this forum. I'm not sure who to thank. I think it's Mina for putting it together. And when going for the organization, thank you guys for having me here. So I was here for the last session you had on bonds, and I understand that you had a few questions after that session. So my goal today is to just make it a little bit easier to understand how bonds work, to answer any questions that maybe you didn't get answers to in that last session, so that we can come out of here understanding if this is a good option for us or not. So ideally, success today will be that you either decide that, yeah, bonds are for me or bonds are not for me. You understand the process very well. You understand how the returns work and how to access them. And if there are any other questions, of course, you can ask me and I'll do my best to answer them. So if there's anyone on the call who does not know me, my name is Valentine Joroge. I'm the CEO and co-founder of Africa's Pocket. And I believe most of you are here because of Investable, and some of you are here because of your Roadmap to Wealth. And those are the two courses that are sort of our flagship courses at Africa's Pocket. And of course, with Investable, our goal really is to help you understand what investment options are there for you. And with your Roadmap to Wealth is to give you the plan to kind of get to your goals. And of course, investments are a big part of that. So this is relevant for anyone who's in any of those courses. And I'm so happy to see this community thriving and continuing to learn even beyond taking the courses online. So in terms of the agenda, I know that you already know what a bond is, you know how they work, you know, a presentation was already given. So I'm going to jump right into the actual pricing. But before that, there's a question that I was asked around how does the bidding process actually work? So I'll start there and then we'll go into the pricing because it flows a little bit better that way. So in Kenya, you know, we're really working towards a much easier sort of bond purchase process. And right now, the way that it works is that you need to have a CDS account with the central bank, which is different from the one with the stock market. Hopefully they will make them one day. I understand that there are people on this forum who've actually used the Treasury Mobile direct trading platform. I have never, so I can't speak to that, but I'd love to hear from somebody who's used it on how they actually went about it. But the first step is in getting an account. Usually you need to go there to central bank to like fill in the forms and stuff like that. One of the reasons why you may want to use a broker or a financial advisor is because they have the permission to do that on your behalf. So you don't have to present yourself directly to central bank. This is something that has existed for a while, but recently a lot of banks are taking up this, are offering this service to their customers to allow you to kind of get into bond trading more. And the reason why it wasn't offered before is that primarily bond trading has been an activity that is done by institutions in Kenya, because you'd find that it's something like 70% of the bond market is controlled by foreign institutions. So you find like, you know, places like the Nordic Development Bank and organizations like that are the ones that you typically buy bonds. But recently there's been more appetite from the general public. So they're working on making it easier for the average retail investor to invest in bonds. So all this is just to say that hopefully it's going to get much easier over the next few years to invest in a bond. So what the broker can do for you is open that account for you and then also do the bidding process for you. Now, the way that the government bonds work is that the government comes and says, okay, we need money to pay, I don't know, teachers' salaries. And so we're going to borrow money to be able to pay those bills. And they say we need X amount this month, and this is determined by the budget in advance, but sometimes the short-term needs change. So they have two avenues. One is short-term, which is the T-bills, which is where you find things like that, teacher salaries, what else do they use T-bills for? Stuff like that. Then you have bonds that tend to be for longer term projects, and you have infrastructure bonds specifically that are for infrastructure projects. So they will use that money to build a road, do water piping, build a dam, that kind of thing. And then you have the other fixed coupon ones, which go into general government spending. So just to provide public goods like free education, for example. So they go and say, we need X money for X activity, and that X money is determined by the budget, and then they issue the bond to the public. Now, generally speaking, when it comes to economics, the government bonds are supposed to give you an economic indication of what people value sort of money at. So it's supposed to be the thing that kind of sets the interest rate of the country, if I can put it sort of simply. And when you think about economics, the easiest way to know the true price of something is to auction it, because you find that the market will stop when it's too high. They will not bid beyond that. And you get to see people's interests, because when you think about an economic situation, you don't know, you don't have all the information. But an auction gives you an opportunity to get as much information as possible. So what you do is you say, okay, government wants 1 billion shillings. So you go out there as Valentine or Corey or whoever, and you say, okay, I have a million to give them. And so if they are needing 1 billion and this is what's happening in the economy, and we know they're broke, or we know Kerry has been collecting, so we know they have money, we think the interest rate will come somewhere around here. So there's like a bunch of research and analysis that goes into it. And eventually people put in their bids. So you put in a bid, and what the bid says is, I want to put in 1 million shillings and I want to get this interest rate for my 1 million shillings. And that interest rate is that big question mark that I'm saying usually takes a lot of research and analysis to come up with what is a fair number. So what the government then will do is take all of these small 1 million bids, and they say, okay, on average, people are willing to pay 12%. So for this bond, we're going to pay 12%. So that auction process happens over a couple of days. You usually put in your bids on Thursday. It's a closed bid, meaning that you don't know what other people are bidding. So you just kind of put in your hat in the ring. And then after a couple of days, I think they usually announce on Monday or Tuesday, they say, okay, this is the average that was offered. And so this is what we're offering the bond at. And then they come and tell you, okay, now you need to pay the money that you said you were going to pay. So if you said, I want to put in my 1 million, you pay the 1 million to the central bank and, add your transaction fees and that kind of thing. So that's why you cannot know how much you're actually going to invest beforehand. It will be your 1 million plus or minus some money. So that's how that bidding process works. Any questions up to there?
I'm sorry, do you mind repeating just a little bit, like a summary of what you've said?
The whole thing.
No, just a summary. Like I missed out a chunk of it. So if you don't mind, like in point form, if I put in 1 million shillings,
then there's an auction that happens, and you're able to you'll hear after a couple of days what the interest rate they'll pay is. And based on that, you will get information about what the transaction costs will be, and then you'll pay your money like on Monday. So think about it like if you go to, you guys have seen art auctions, right? Where people are like, this, I'll do this, I'll do this, I'll do this. That's an open auction. So with the case of bonds, it's as though you've put in a ballot and you say, this is my number. Then they calculate what the average is, and then they come back and give you the information based on majority, and majority doesn't mean how many people, it means how much money, how much. So if you have several people who are putting in 1 million, and one person putting in 10 million, the 10 million carries more weight than the 1 millions. So it's about how much money has been offered at a certain interest rate, and they get the average of that to be able to say, this is the interest rate that we will pay for this particular bond. Is that
Thank
better?
you.
Is that better?
Thank you. Thank you for the
Okay.
summary.
I see some questions here about how can a young person interest in stocks but no ID take up a CDS account. You can, actually, I don't think they allow you to do this anymore. They used to allow you to open an account care of, but people use that to embezzle. So I don't think they allow you to do that anymore. So I think you must have an ID. But you can check with the broker. I'm not sure what the rule is anymore. We can check with a broker and let you know. Someone asked, if the interest rate is not favorable to you, are you permitted to withdraw your offer? No, you're not. So if your bid is accepted, you have to pay. And if you don't pay, you're penalized, and you can be like banned from ever taking part in bonds or for a period of time. The thing that is beautiful and unique about the auction process is that you know it's going to be fair. You know, no one is going to take a bad interest rate for whatever reason, right? Because that is a market manipulation and a little bit of sabotage. So you can rest assured, given how human beings behave, that the average price will be fair. It may not be exactly what you want, but it will be a fair price because majority of people want to kind of take part in that. So you can think about it like selling land, right? So the price is the price at that point, and you can eat with the land, you know, you can decide to wait. But in this case, you've kind of made a commitment. And that's why we say bonds you should be thinking fairly long term with bonds. And you should be putting, this is money that you're kind of trying to safeguard to preserve your capital. So this is not where you come to make outsized returns. This is where you put your money to preserve the capital. So it's very unlikely that you lose the principal that you've put in. Okay, so let me share my screen and we can look at the bond calculator. So actually, before we share this bond calculator, now I'm going to share an Excel sheet that looks complicated, but I will walk you through it step by step. And it's going to have some words over there like dirty price and clean price, which sound very confusing. I will explain them in as simple terms as possible. As we go through this process, I want to just point out that there's some really extreme levels of bond trading that can get very complicated. And it can be like, oh, you know, if you sell this time, buy this time, blah, blah, blah. I don't want to go into those strategies because as a retail investor, the role that bonds should play in your portfolio is to preserve your capital. So I'm going to go into this example with the assumption that we're buying bonds for the long term and for goals that are, you know, fairly far in the future. So you're not too concerned about trading here and there. We will go through a scenario of selling a bond before it matures because emergencies happen. But bonds are not, especially in our markets in Kenya, it is not a good idea to trade bonds. You're not going to make money that way. There's no real arbitrage opportunity because our bond market is fairly immature in the sense that it's not rich. And the process is so complicated that the time, the transaction costs, etc., all make it not worth it to optimize these small amounts. So let's, with that disclaimer, we can go from there. Oh, there were some other questions here. So I see any experience with foreign currency denominated bonds, for example, Africa Euro bonds. No, so today I'm just going to talk about the central bank and what the central bank is offering currently, and I'll focus on infrastructure bonds, which will give you a good understanding of most of them. Because once you start doing different denominations, then you start having currency risk and complications, which make it a much more complex undertaking, which is, I don't think, necessary for now. So this is the calculator we use to do pricing. It looks complicated, but it's not that complex. So this is the bond that came out in February. It's the IFB one, and you remember how Rachel taught us how to read it. So 2021 means the year, and 21 means how long the bond is open for. So that's the issue number. This is the coupon rate that was announced after the auction happened. So this is the issue date, which is 13th of September, and it matures on 18th of August in 2042, which is 21 years from now. Now, with infrastructure bonds, if you invest less than 1 million shillings, your amount is if you invest more than 1 million shillings, your amount is redeemed in 2 portions. So 50% after 10 years, 50% after 11 years. If it's a higher amount, you'll get 2 amounts. If it's a lower amount, you'll get 1 amount at the 10-year mark. So you don't actually keep your money in there for 21 years. In this case, it's 10 years. Then they come and tell you the next repayment date is 13th of March, 2023. So you buy the bond in September, and your first coupon you can expect to be on 13th of March, 2023. So let's take a scenario where you invest on the right day. On the day that the bond is issued, right? So you put in your bid with everybody else, and you actually bought the bond the day it's bought in the primary, the day it's issued in the primary market. This is what to
21.
Oh, sorry. Thank you.
Awesome, thanks.
Yeah. So you see that the period to your final redemption is 21 years, which is the tenor of the bond, right? Because at this point, it's assuming that you're investing a huge, large amount. So let's actually start with the large amount, the typical scenario. So if you invest 100 million shillings, you can see that what happens is that the redemption dates, you have 2. The first one is after 10 years, so they redeem 50% after 10 years, and then the next one after the 21 years is done, you're able to get back 50% of your principal. So that's how that works. But in our case, unless we have some ultra-millionaires over here, let's assume we're investing 1 million shillings. And in that case, you'll get all of the money back in September 2031. Are we together? Okay. So I see someone asking in terms of risk, should I be afraid that the government has overborrowed? We'll talk about risks at the end of the call. Okay, so because we're investing the same day the bond has issued, there have been no days when interest has accrued. It's 0, which means that the interest accrued is also 0. And then we calculate what is the interest every 6 months. It is a consistent amount for 6 months over the 10-year period, and we'll go into that just now. And then what is the interest to accrue to maturity, and it calculates that amount over there. That's not a very important number. And so you see in this, yeah.
What is the days accrued interest accrued? What does that mean?
I'll show you with the next example. So for now, let's do when you invest the same day that the bond comes out in the primary market. And then I'll explain these when we're doing the secondary market. So in this case, you see that your dirty price is 100, your accrued interest is 0, and so your clean price is also 100. So this tells us that the dirty price is, your clean price is your dirty price, which is the normal price, like the empty, like without everything. And then you add on your interest and you get your clean price. And your consideration is the amount that you're investing. Then here it comes and breaks down your transaction charges. So we put it together as one amount, 0.03%. And you can see how it's broken down. So your brokerage gets a commission, the CMA, the NSE, and the CDSE also get a commission for doing the work of opening and maintaining your account. There's VAT, and so you see your total charges there. So your broker gets 500, these other institutions get 110, KRA gets 80. So the total transaction charge that you are charged is 690. So when you're sending the money to central bank, if you're doing it yourself without a broker in between, you'll send 1,690,000. And then of course, there's a charge for sending that money to central bank. So you can send it through RTGS, you can send it through M-Pesa, there's a charge associated with sending that money. Of course, if it's 1 million, you will not be able to do that. So let's talk about the interest. So you sent your money. Today is 13th of September, you sent your money, it's been invested. On 14th of March next year, you get your first 63,000, and that continues all the way until the 1st of September, 2031. And on that day, 1st of September 2031, you also get your 1 million shillings that you invested. Are we together until then?
Yes.
Could you
Sawa.
please
Yes.
explain why it took 10 years and not 21 years?
So infrastructure bonds are special in that way. And the rationale is really so that because infrastructure projects take a long time to pay back. So the government structures infrastructure bonds in such a way that they can reduce how much they're paying over time. So they will redeem half of the amount after 10 years and the other half of the amount after 21 years. So if you invest a small amount because of the administration and time required to service a small investor, they kind of bunch the small investors together and redeem all of that in the first 10-year tranche. Is that clear?
Yeah. Please, thanks. So a small amount would be 1 million. Between what amounts?
So I think I think they usually start paying it like this after 20 million is when they'll pay you half. Let me confirm. Yeah, so once you get to 20 million, then they'll do half in 10 years, half in 21 years. If it's an amount below 20 million, all of the amount will be paid after 10 years. I'll confirm the actual number, but I think it's 20 million.
Question.
Thank you.
Mm-hmm.
If I remember correctly, I think the prospectus that you went through in the last session actually stated 1 million.
Oh, it was 1 million. Okay. My apologies.
Yes.
So
question. If I'm getting the amount repaid, so I've bought a 21-year bond, but I'm getting repaid in 10 years time.
Yeah.
Does that mean that I'm only getting the interest for the 10 years that they've held my amount?
Yes.
Okay.
So let's look at that. So this is our scenario. We've bought we want to put in 1 million in our bond. So let's look at what the transaction costs actually look like if you use a broker. So you have the 690 that I mentioned over there. And this 690, I believe, I'm not sure if anybody here has used TMD, but I believe they will still charge you the 690, at least for CMA, CDSC, NSE, VAT has to be there. And I still believe that they charge you a brokerage fee because there's a sort of custodian broker that still manages the transactions on TMD. I'm not sure about that, but let's assume that you pay it. Then in the case of Hazina, you'll pay your 2,000 account opening fee. And then this is the cost of sending funds. So sending funds to central bank, in fact, you should add another sending funds to your broker. That's the RTGS fees. So your total transaction costs are 3,890 shillings, which is 0.38%. So this is the true transaction cost. Then this is the situation where you're buying in the primary market. So your accrued interest is 0. So the actual money that you send is this 1,03,890. That's what you send to your broker for you to make an investment of 1 million shillings. Are we together? I'll assume that's a yes.
Yep.
Okay, so let's come and see now what happens with a coupon. So we mentioned that you're getting your money every 6 months, and they have the actual dates over here. So in the case where for some reason it's a weekend, it will move and so on and so forth. And these coupons are actually calculated not as a date. So it won't be like 13th to 13th. It will be 182 days between the coupons. And that will help with managing irregularities, because as you can imagine, if the government is wanting to do, lots of, if they want to have lots of retail investors, the more standard it is, the easier it is for them to manage. So they want to be able to send the same amount of money as consistently as possible. That's what they're optimizing for. So that's why they do it like that. So you'll get your money, and on on 1st of September 2013, the total amount of interest you'll have received is 1.273700. So that's I just added all of these amounts up. So you get 1.2 and you get your 1 million. So your total payout over the course of the investment is that 2.273. We're together? So,
Yep. Yes.
so this is the number that I have here, your total repayments, 2.273. So what I've done for the return is I've taken your 2.273 and I've subtracted the actual cost. So this is the amount you earn on your investments. So that's what it looks like to buy a bond in the primary market. Any questions?
I was just typing in the chat. There's a question around if there's brokerage fees if you are buying from CBK as an individual.
I've never been able to do this personally. Has anyone managed to do this? Like through the TMD service, maybe you can tell us. Okay, we can ask in the WhatsApp group. There's somebody who had said they had managed. I don't think they should charge you, but I wouldn't be surprised if they do. But it's 600, so it's okay. So I see over borrowing. Is this what they call amortized? So this type of bond, we don't pay tax. Yes. So with infrastructure bonds, they are tax-free, and they want to incentivize you to invest in infrastructure bonds because we're a developing nation, and so they need lots of money. Anne, I see your hand up.
Yes, I don't understand how I put in 1 million and then I got back 2 million plus. How does that happen?
So you didn't necessarily get back 2 million plus, because remember these payments are coming every 6 months. But when you add the sum of all of your payments,
okay, I get
you get 1.2. Yeah. Okay. So let me show you now some numbers, some percentages. Huh?
We have another question. Mine is asking, what's the advantage of this over money market apart from the slight percentage margins?
So that's a difficult question to answer because it's not comparing apples to apples. They have different purposes. So when you think about a money market fund versus a government bond is actually a lower risk investment instrument because the risks that you're facing, maybe we can talk about risks now. The risks that you're facing is that the government collapses and is unable to pay. But even in that case, like you can see our government right now raising taxes left, right, and center to pay their debts. The next thing they can do is print money. So the chances of that happening are very low. Of course, they have happened. We've seen it happen with governments like Greece and so on and so forth. But the chances are slim to none. And more often than not, what the government will do is, well, in our case, we have a lot of foreign debt, but they will prioritize domestic debt because you don't, as a government, you don't want your people unable to have money, especially with something like government bonds, where people tend to invest things like their pensions. So that's one. It's actually a lower risk investment opportunity. Now, the way to kind of think about managing a bond so that it's as lucrative as a money market fund is when you get these coupons, put them in an investment. Then you'll see very good things starting to happen. You can use them to buy shares, you can put them into a money market fund, etc. So let me explain why a money market fund is riskier than a government bond. So like I mentioned, with a bond, the only thing you have to worry about is a government collapsing, which arguably, if that happens, all these other investments you have also have collapsed, really. So that's one. Then with a money market fund, the things that you need to worry about is the whole makeup of the fund. So a money market fund will have some government bonds, it will have some fixed deposits at banks, It will have some commercial paper with corporates. So your risk is actually spread to a few more people. And the chances, your chances of something happening increase. And of course, if you think about all of these organizations that I've talked about, banks, other corporations, if there's a serious issue with the government, they are also affected. So, so government bonds are a much lower risk opportunity for a higher return. That's not to say that money market funds don't have a place, because they offer you liquidity, they offer, automatic compounding. There's a lot of good things about money market funds, and there's a place for them. And one of my favorite ways to use MMFs are for emergency funds and for accumulation. But when I want to leave something for a long time and forget about it, the bond option is usually very attractive to me, especially if I want to have cash flow from that investment and be able to direct it to a different asset class. So it helps with diversification as well, without necessarily pulling money out of my pocket to kind of build that diversification. I hope that answers the question. Then I see okay, Hongwe has answered the question about the minimum. Yeah, the minimum investment for infrastructure bonds is 100,000.
Yeah, there's one other question. When a bond is reopened or re-advertised by CBK and you purchase the bond through CBK, is it still considered a secondary market purchase?
No, so a secondary market purchase is where you buy from, not directly from the government, but from another investor. And when they reopen, it's called a reopened bond. So it has a different calculation, but it's not the same as a secondary market purchase. But they're similar, but not the same.
Great. Thanks.
Okay, so we've understood what happens when you buy from the primary market. You put in your money, you have your transaction costs, there's no element of accrued interest, and you get your repayments. So the way to calculate the return is to take a total of your payments and kind of subtract from your initial investment, and you'll be able to get a good sense for how this compares to another investment. There's another one step you can take to annualize this return, but I don't want to do that because that's deep finance. This is one of the big advantages of having a broker. They will do this for you and will actually give you the actual maths, and what you're paying them is not that much. So I know fees were a concern, but this is one of those situations where you ask yourself about cost benefit. The amount of time it would take to fill the form, go to central bank, you literally put those forms in a box over there, they do the auction, waiting to hear back, it's hectic. So there's a real value in kind of working with a broker to make this happen, unless you're conversant with the TMD, which has made it super easy. I am still trying to figure out how to sign up to it. So the person who did it to me, I wanted to talk to them so that I can do it too. But part of the advantage of a broker is that you can have them do annualized returns for you, and you can compare to other investments. But a big pro tip is when you get these coupons, don't spend, put it into another investment, and you'll start building a very sizable portfolio, because you can see it's a lot of money. It's 1.27 million. So imagine if you invested it to be even more than this. Okay. Let us go to secondary market. So I'll use the same bond, but kind of put it in the future. And then we'll look at a bond that has already happened in the past to kind of bring the concepts together. So I'll do it a year from now. Let's keep it simple. So it's a year from now. So same parameters, same coupon rate. It opened on that day, the same maturity, and you can see here the period to final redemption changes from 21 years to 20 years. So this is the date that I put, 13th of September, 2022. So 20 years, yeah? So in this case, you come and see that the interest accrued is 349, which is a basis point number, which means it is not, you need to multiply this by, I think it's 100 if I'm not wrong, to get the actual number. Then you're able to see what the remaining interest to maturity is from the day you invest to the end of the bond. And now things start changing over here. So your dirty price and your clean price really just reflect adjustments that the bond issuer makes to compensate for the interest that has been accrued from the time the bond was issued to the day you're buying it. That's literally what these prices do. They just adjust for that, because remember, the government wants to pay you the same amount. They want to pay everyone who invested 1 million the same coupon. So the way they manage to do that is by adjusting how much you're paying at the beginning so that it normalizes you. It's as though you've been investing from the first day. Are we together?
Could you repeat that?
Please repeat.
Let me go to my simpler spreadsheet to make it easier. So I repeat everything. Okay. So let's say that we decided to buy the bond 1 year in the future, 1 year from now, or we can imagine this bond was issued 1 year ago and you're buying it now today. So what has happened is that there has been 1 year when interest has accrued. And that amount is calculated by saying 1 million times the coupon rate and then the number of days that have passed since then. Are we together until there?
Yes. Yeah.
Okay. So what they now do is say, let me add, there's something wrong here. That's why this example is not returning so much. Seconds. Okay. Let's do 23. That will be easier to explain. So the interest rate is calculated. So here it's a bit clearer. The interest rate is calculated from in this case, what they've done is they've calculated the interest that has accrued from the last coupon date up to the day you're buying it. So you're able to see what the total interest accumulated is in that period of time. And in this case, it's 32 days. So if I change this to, so September is the last time they paid, October is 32 days since the last payment. So if I change it to November, you see that the number of days increases and the total interest accrued from the last coupon date to that day increases. So what the government now does is they tell you, increase how much you're paying by the interest that has already been accrued so that we normalize you, so that everybody gets the same coupon payment at the next payment day. Everybody who invested that amount, 1 million, gets the same coupon payment the next payment date. Are we together there? Has that explained it better?
Yeah.
Okay. I see someone's hand is up. Rael.
Yes, Valentine. I want to clarify something on that secondary market trading.
Mm-hmm.
What really controls the secondary market trading is the yield to maturity rate. I see you have not changed the YTM.
Okay.
A bond in the secondary market can never at any time trade at the rate it was issued with. So that is basically what determines the secondary market, what is trading during the time of trading. So the whole of this pricing, it will give you a wrong figure until you change with the current market prevailing rates. That's why you always do a pricing when you are sending the investor or the buyer with the current prevailing market rates. So at that example, you can never use the 12.737. That did not even trade in the secondary market at all. When the bond started trading, it started trading at 12.4. So you can maybe use the example of 12.4 as the YTM, just as an example. Thank you.
Thanks, Rachel. So basically what's happening here is that we're trying to normalize the, Rel, you have your hand up again. Is this Rachel?
Yeah.
Sorry.
Yeah, would you like to say something else? No? Okay. So Sharon, I see you say the later you join a bond, the more you pay at entry. Does this mean it's best and cheaper to go for new bond issues? So I'm trying to explain the secondary market trading without getting into the intricacies of like yield to market and things like that. And Rachel has made a very good point, which is that your yield to market can never be the same actually as your coupon rate, which is why there's reason to trade the bond in the first place. But ideally, what the pricing strategy or the pricing approach in the secondary market is that you will pay a little bit more to normalize you so that you kind of pay for the interest that's accrued since the last coupon payment, and therefore you normalize the coupons that are being paid at the next payment date. That's typically what's happening with a secondary market bond without getting into the deep finance stuff.
Can I ask? So that means eventually the money you make out of that bond minus the cost you bought it at, you actually get less returns compared to someone who bought it when it was floated by CBK through CBK, right?
It depends. So like anything in a secondary market, the market decides the price. So it depends. If it's a situation where, you know, it's hot and everyone wants it, what will typically happen is that people will pay more for the bond in a secondary market. But you could be in a situation where the person wants to offload, and so they're able to give a discount, and so you'll pay less. And Sisi has asked a great question. It sounds technical. What's the importance of understanding the difference? As a retail trader, there's no real point of understanding the difference unless for some reason you want to offload your bond much earlier. And you know, the reasons why you'd want to offload your bond will determine how you behave in the secondary market. This is another reason why working with a broker makes a ton of sense, because the person who spends all day kind of thinking about bond trading will be able to tell you, hey, for this one, you can get a little bit more. For this one, you can get a little bit less. It's kind of like selling a house. If you're in dire, or selling a piece of land, if you're in dire need of the cash, you will take a discount. If everybody wants the land that you sit on, you'll be able to command premium. I see someone's hand is up. Evelyn?
Without going into the complexities of the YTM, personally, I have great interest in this secondary market because I believe I will offload bonds and maybe at some point even get into trading. So the YTM, even if you're not making it complex, what determines this YTM? Is it the broker? Is it NSE? And if I was to buy, let's say, if I'm interested in the same bond, will I get it at the same price at FIDA? Will I get it at the same price at Drummond? Will I get it at the same price at Diane Blair if I'm getting a costing for the same day?
So maybe what I can suggest is that you have a cyber with Rachel. Rachel is a bond trader. She can explain this. I am not a bond trader. I'm an equities girl. That's what I did when I was in investment management, really. And the answer is the market determines the yield to market, really. It's about how the market is moving, ideally. The underlying sort of mechanics that are happening, I'm not sure how they work in the Kenyan market. Maybe Rachel would be better placed to answer that question. Rachel, do you want to give us a quick explanation that's not too technical?
Thank you, Valentine. Evelyn, thank you for your question. What really governs the YTM rates? Every week there's usually a yield curve given by NSC. It gives a range. And remember, secondary market trading is all about those who have the stock or the holdings trading whatever they already have. So it depends. If, for example, I give an example with this infrastructure bond that Africa's Pocket are using. There is a rate for buying and selling. So to ensure that it is properly regulated, they give a range. So if you who is selling knows the rates that are trading, you will try and sell at the lowest rate. But the one who is buying will try and get the highest rate. That's where a broker comes in, because they're in a position to know where do we get the offer at the best rate. If it's a bid, where do we get the bid at the best rate? So it's not something that is a constant, that all the brokers are doing the same thing. But for us now, when we are trading in the trading platform, we can be able to see what is every other broker doing, what rate is trading. If we get, like what Valentine has just said, if you are in dire need of some cash, you can sell your bond at a discount. So at that time, you will maybe make a loss or make lower return. You'll have done a best rate, maybe even not even trading at the moment, but it all depends with what is available from any other broker. When you are trading, you always look at the best rate. So it's not something that it's constant at Daya, FIDA, KCB custody, it's trading constantly. No, every broker has their offers, every broker has their bids, but there's always that average, that rule. Thank you.
Yeah. So literally, you just think of it like any form of trading, whether it's Forex, crypto, bonds, shares, the things that determine the price are quite a few. It's psychology, it's liquidity, there's quite a few factors that determine pricing, and with bonds, it's the same. And so, like Rachel is saying, it's if you want to do the secondary market thing, and if you think that, not even if you think, ideally you should hold the bonds for a long time. But of course, in the case that you need to liquidate it, it is useful to be able to turn to a broker because they are plugged into the market. So they can help you offload it, just like working with an agent to sell your house. Okay, so though somebody who had asked about the risks, although we've kind of talked about them. So any questions at this point?
There are a few that have been in the chat. One is about layering. So, oops, I've lost it. Valerie asked, please explain how one can do layering of infrastructure bonds to enjoy coupon interests regularly. And then I had answered in the direction of, investing in different bonds with different coupon rates to like spread when you get coupons, but can you expand on
I did not know that this strategy was called layering, actually, because when you're being taught about finance in school, layering is kind of not good. But anyway, so the strategy that's being referred to here is one where you buy bonds that have different coupon payment dates, so that every month you get a coupon payment. And again, a broker becomes useful in making this happen because they can kind of normalize your cash flows by giving you a good sense of what bonds are paying coupons at which times. Now, I don't think we have enough infrastructure bonds to do this successfully exclusively with infrastructure bonds, but you can definitely do it with a combination of infrastructure and FXD, which is the fixed deposit bonds. How frequent are the infrastructure bonds released by government? They're usually like 2 or 3 a year. How many are they, Rachel? Unknown. There's a bond every month, but I don't know how many of them are infrastructure bonds. It depends on the budget, usually. I see Sharon has raised her hand.
My question is, like, when's the latest you can enter a bond before the tenure ends? Like, if it's if it's going to close in 2042, for example, can I enter in like 2041?
There's no point of doing that.
No, but like how late does it end? Yeah.
So with the secondary market, it depends on the market, right? Anything that's with the secondary market depends on liquidity of the market, availability of appetite, blah, blah, and all those different things. So it's unpredictable. But when you do the math, you'll see there's it doesn't make sense to do it just before the bond closes.
So like, sorry, as a follow-up, what would be your recommended maybe minimum closest to the 10-year, like, or should you just always aim for bonds that have a longer period, like 10 years plus?
So there's a calculation that can be done to kind of figure out, like the tipping point, the at what point does it stop becoming an optimal financial decision? And it depends on the bond because all of them have different pricing. As you've heard, the yield to maturity will change. So there's a calculation that can be done. I won't go into that now because for the purposes of us investing as retail investors for the long term, there's always going to be a bond available that you can buy in the primary market unless there's something super special about an old bond. There shouldn't be a reason for you to really do that regularly. But if you're interested in that specific niche opportunity, that's, again, use your broker. They'll do this work for you for 500 bob.
There was another old question that was to do with any experience with foreign currency denominated bonds, e.g. African Euro bond. So it's a very special case. And what are the requirements?
I have no idea about foreign denomination bonds. That's level 4 of investing. Rachel, would you like to tell us about like Euro bonds? Oh, I see someone explaining layering is what the chickens do. That's interesting. So would it also be called layering if, because the strategy that I love to employ when it comes to government bonds is like reinvesting the coupon. Would that also be considered layering? I wonder. Okay. Any other questions before we wrap up? We have 5 minutes.
Yes,
left.
I do have a question.
Mm-hmm.
So in terms of the overall strategy based on like the wealth building plan that we're sort of like looking at the different segments of capital growth, capital preservation, etc. Where does this fall, right?
Mm-hmm.
And if you're younger, like you have a higher appetite for risk, you can put it that way. To what extent would you diversify your portfolio, putting like what percentage would you advise to put towards long-term bills and bonds in terms of how much you may gain in the long run, as opposed to taking a slightly riskier approach with maybe some that can give you a higher return? And finally, how would you advise, like, let me think about the last question, how I want to phrase it. Maybe you can just answer the first two.
Okay. So I'm sure by now a lot of people have told you it depends, but I'll give you like I'll share my personal approach, and then you can go from there and kind of see how it fits into your life and the things you want, because your investment decision should be driven by your goals, not by, like an ideal sort of allocation approach. That's a different way of thinking. With Investable, the philosophy that we're kind of using when it comes to investment management is goal-based, right? So in my case, I had the same thinking. I'm young, let me take my risks now, and I have time to recover in the future. So between the age of 25 and 30, or let me say 28 is when I stopped doing the shenanigans. I used to invest in very high risk opportunities almost exclusively. So I would invest in farming. I would invest in people's businesses. I would give, people who are in microfinance money as debt, and they'd give me back 25%. It was wonderful until I started losing money in some of these ventures, because it's really very nice for the first year. And then after that, things start depreciating because it needs a lot of your time. So I did my maths. I did my overall portfolio analysis. And it turned out that with all I had, and then I also had a lot of cash. So I used to have cash kind of sitting for longer than it should. So when I did the average return of my portfolio over, it was, I think, a 3-year period. It must have been 24, not 25. The average return was about 11%, which was heartbreaking because I could have just put my money in a government bond, gotten my 12%, and chilled, because in the harakati of doing all of these hustles, I was also extremely busy. I was always running around. I had a lot of stress. There was a lot going on in my life when it came to investments. So now the way that I think about it is a bit differently. There are things that are in my, there are things that I know are going to happen in my life. I know I'm going to have, hopefully, kids at some point. I know I'm going to retire, that kind of thing. So with those things where I need my base to stay the same, my capital to stay the same, I put those money towards those goals in fairly stable opportunities. Like, I love bonds. I think they're great. So I'll put a big chunk of money there. And then I'll spend a much smaller percentage of my portfolio doing these high-risk crypto, IPO, venture capital type of things. And what that has done is, because a majority of my portfolio is in predictable opportunities, I can predict how my wealth is going to grow over time. And then this other small portion allows me to have opportunities to expand, not to expand, but to make these outsized returns sometimes. But if I lose, I don't lose so big. So it doesn't bring the average of my portfolio down. So with regards to allocation, it has to depend on your goals and your priorities at this point. So now that I'm, kind of where I am in my life, I have a big part of my portfolio in Africa's Pocket, which is a venture, high risk venture. And then everything else for me as an entrepreneur, I try to balance it. So I have a big chunk of my money in things like bonds and things like real estate that are a little bit more stable. Now, if you're in a situation where, you have a very steady source of income, you have a house, for example, maybe your kids' education is sorted and now you're like, okay, let me do these high risk things, then your mix would look a little bit different. So that's how I would answer the allocation question. Make sure that your base things are sorted, and then normalize your portfolio in such a way that you don't have, 2 or 3 things that can bring everything down. The reason why, and the way that I approach my bond investments is, typically I would invest through a company. I've just started investing first as an individual, actually. But what I've been doing is I put in the money every 6-ish months. So I accumulate through a money market fund. Then I'll buy a bond whenever there's a good opportunity with the bond. Then when the coupon comes, I use that to invest in a different asset class. And so very quickly, within about 2 years, I was able to have a nice base from a government bonds perspective, a nice chunk in equities, and then hopefully I'll also be able, the other big advantage of bonds is that you can leverage your bonds. So I'll hopefully also be able to borrow against my bonds very soon to, do another different kind of investment, which probably will be something like real estate. So that's how I would think about allocation.
And when you think about the long-term aspect of bonds and something like retirement, then would you advise to have both a retirement pension scheme at the same time having that long-term perspective in terms of the bonds themselves? Like, how would you balance the two?
So I think in our retirement schemes in Kenya have a very low return. So I would first check the return that your scheme is giving you, and then see if you want to kind of increase that return, and you can add on another, you can layer on another investment to kind of top it up. The other thing is, so I don't necessarily think of bonds as sort of like my retirement, because I'm, my retirement is very far away. So I don't think of buying bonds today to kind of cater for my retirement, but I think of it as a way to kind of build up the cash I need to build very long-term assets. Because yes, 25 years, 21 years is long, but if I'm thinking about an asset that can take care of me throughout my entire retirement, I need an asset that's actually going to last me 50 years, 100 years. So bonds are sort of like my stepping stone to that next step. If that makes sense. But it also makes a ton, if you're about to retire, it makes a ton of sense to take your pension money and then buy a bond that then gives you cash over a 20-year period. A lot of people do that in retirement. So you accumulate money in other places, then when you retire, you buy a bond and you know you're going to get your coupon every 6 months to take care of your bills. That's another way to think about it as well. Okay. So I hope that this has kind of brought bonds closer to you, closer to your investment plan. And for me, what I would urge is let the professionals do the calculating and the figuring out the trading and stuff like that. For you, you have the understanding of where this fits into your portfolio, know how to work out what your returns will be. Of course, ask the questions about the fees. At least you have an idea of what they should look like. But I feel, getting into these very deep finance concepts adds little to no value. Our bond market is amazing in Kenya. The fact that you can get 12.7% coupon on a bond is pretty amazing. And I think our government is pretty stable. You hear all the news about we're overspending, we're doing etc, but when you look at it from a long-term perspective, Kenya is a country that's has a growing population, people work hard, businesses are growing. It's unlikely that our government will collapse. Unlikely, not impossible. Winnie asked, are you going to talk about Hazina? Okay, I didn't, and it's 1 o'clock. Okay, so what are the questions about Hazina? So Hazina is a product that FIDA has brought to us to make it very, very easy for you to buy government bonds. And the way it works is you open sort of a nominee account with them and they buy the bond on your behalf. So you actually buy the security itself, the bond itself. It's not a fund. You are the owner of the asset. And the thing that's special about Hazina is that the bank FIDA is providing liquidity for you. So if you buy a bond through Hazina, you need to hold on to it for 1 year. But after 1 year, if you need to sell it off, they will kind of buy it back from you. So it takes away. So right now, selling anything in the secondary market is extremely difficult. It takes long. You need to kind of have a broker who's very in the money and things like that. So this kind of solves that problem. So it's easy and convenient to do it. You can open the account online rather than having to go to central bank and getting them to do this for you. It is, and then they provide that liquidity. These are the two biggest advantages of this product from my perspective. So the way we're working with FIDA, Africa's Pocket, is offering, we can do this process for you. We're able to help you with onboarding. And the reason why this is interesting is that as Africa's Pocket, we are creating an investment platform. So our goal is to be able to bring you a bunch of opportunities in the same place. And our vision is to allow you to see your entire investment portfolio on one platform. So you know exactly how much you are worth, how much you owe, how your investments are moving. And so this is the first step to us doing that, is offering this bond in partnership with FIDA. So eventually you'll be able to do the bond, you'll be able to buy some shares, you'll be able to buy a money market fund, and inshallah, we'll be able to even create portfolios for you so that you can invest in certain sectors, in the Pan-African investments and things like that. That is the vision and the goal. So what timeline are we talking about with this IFB in place? Is there a deadline? So the bond is already issued, it's in the market. What Hazina gives you is the opportunity to get in whenever, but of course, like we've heard, the pricing changes. So you'd rather start sooner rather than later. Okay. Any other last questions as we close off? Okay.
Make a comment.
Oh, sorry.
This is just in regard to some of the queries and comments that have been coming up on the WhatsApp group. And for me, having opened up CDS account, both the nominee under Hazina as well as directly with CBK, I feel maybe there's a bit of confusion or some gaps that people maybe are not aware of. And that is probably what is resulting with some of the challenges after opening the CBK CDS account. So for me, two things stood out. Once the account had been opened, the first thing is that you need to actually go back to CBK and ask them to activate TMD for you. It is not an automatic process. You actually have to go back, fill out the paperwork, and ask CBK to activate TMD for you.
Yeah.
Once that process has been done, then you will find that within a period of 1 to 2 weeks, they will formally get back to you and tell you that your TMD service is now activated and you can now comfortably use the USSD code for the TMD service.
Yeah.
The thing is that if you envision ever liquidating your bond, again at CBK, you need to kind of link or identify the brokers through whom you would wish to sell this bond in future.
Yeah.
Those are things at least I was not told upfront, but having listened online to a session that had been done between Rina and Alex Washira, who is the head of at FIB. Those were two things that I think people forget to do and then subsequently end up with challenges down the line where it's not clear how to proceed.
Yeah. How to go from there. That's
Already
the reason why I've never been able to do TMDs, because I'm not in the country and you need to go there physically to do it. And hopefully we'll change that. We're working on making it easier to invest.
Yes.
Sorry, did I interrupt you? I'm sorry.
Yeah, and then there's someone who made a comment. I can't remember whether it has been formally responded to. It was somebody by the name of Sheila who was commenting about her mom receiving multiple messages about a dormant account. I have been receiving, or rather I have received such messages in the past. So for me, what I suspect the mom is getting actually has to do with the shares, the one that is under CDSC, the one for stocks, not the one for bonds. So I hope to all of us that it's clear that there's a CDS account under CDSC for shares and stocks, and there's a CDS account under CBK for bonds and bills.
Yeah, there are two separate ones, which will hopefully one day they'll be joined into one singular account.
I have a question regarding that. When you have a dormant account and you had shares before, when you reactivate it, do you still have your shares intact or what happens?
Yeah, you do still have your shares intact, but you need to pay a fee to activate it.
Okay, all right.
So Violet asks, if you already have a CDS account, what are the next steps with Hazina? So with Hazina, we'll just open the nominee account and then we'll be able to buy the bonds on your behalf. So someone says, if you can please speak a little bit about the nominee account and Hazina. What question do you have specifically around the nominee account and Hazina?
I'm wondering, Val, are they different products? I might have missed the clarification. Because Evelyn just said that she opened a nominee account and she's also with Hazina as well, unless I got it wrong. So I'm wondering, are they different products? If you could please shed a little bit more light on that. Thank you.
Sure. So the way to think about Hazina is that it's a service that FIDA is offering to make it easier for you to buy a government bond. And still, for you to buy a government bond, you need that CDS account with a CBK. So what Hazina will do is it will open that account for you. but it will also open a nominee account within FAIDA, so that if you need to buy and sell your bond, they're able to do that simply without necessarily having to do the full process in the back end. So you need to open, so if you want to participate in Hazina, you need to open an account with Hazina, and then you need to open an account with Central Bank. Those things require the same documents. So once you submit your KYC once, we're able to open both if you want the service of the account, as well as the service of the of being able to liquidate your shares. Hazina is not a broker. Hazina is a product offered by FAIDA. So FAIDA is the broker.
Thank you.
Okay. And we have the FAIDA team here who can talk more about Hazina. They are much better placed to answer the questions around that. But the big advantage of Hazina is that it gives you that convenient way to buy bonds, and gives you liquidity as well. So we'll share the email address where you can ask any questions that you have. Anyone else with a question?
Just to clarify, Hazina is a product within FAIDA that enables you to buy bonds.
Yes, in a nutshell.
In a nutshell, okay, thank you.
Yeah.
Hello, hi Valentine and Wangoi and team.
Hello.
Hi.
Hello, my name is James. I work at FAIDA. I was just following in the meeting, and it's a good conversation you have here. I think I got wind of some two questions that I'd like to address. I think someone was asking when's the like the last period of time you can invest in a bond, as in bonds normally close. The period of sale normally closes 5 days towards the next coupon payment. So you can buy a bond even as late as 5 days to maturity. As long as it's before 5 days, you can still invest in a bond. Yes. And I think the other one that I caught is about the CBK CDS account. Also, your CBK CDS account can become dormant if you don't purchase any holding within a period of 1 year. It can become dormant as well, and CBK will therefore send you some messages asking you to activate it. So you'll have to fill a dormancy activation form that you send back to CBK. And about our product, our Hazina fixed income product, we are currently offering the latest infrastructure bonds. That was IFB 22 and IFB 23. The former one was an 18-year bond, and the one issued in September is a 21-year bond, offering coupons of 12.67% and 12.73%. Both are tax-free. So we are still weighing in on the options of like buying bonds for our clients on a monthly basis in the primary market. So also that we can be able to assist you in case you want to invest with us in our Hazina fixed income product. And we work closely with Africa's Pocket, and that's why we joined the meeting. Thank you.
Awesome. James, maybe you can speak a little bit about, like, at what point does it not make sense to buy a bond? So the question I think was Sharon who asked this question was, okay, if the bond is maturing in 21 years, does it make sense to buy it in year 20? Like, just, it's possible, but does it make sense?
Yes, it's possible. Like, if I wasn't there at the beginning of the presentation, but if you shared with your clients how you can make capital gains when you're investing in bonds, even in the last year of maturity, you can still make it. Actually, it just depends on your investment needs. If you want to invest in the long term and gain the coupon interest and the final redemption, or if you want to make the capital gains and you're looking to make profit, that's how maybe most of the banks and most of the insurance companies operate. You can still buy a bond in the last year of operation and wait till the yield to maturity drops, because that is how you make your capital gains. Once the yield to maturity is lower than the coupon rate, or is lower than the yield that you bought it at, you'll have made your capital gain. So it's still possible to make money even in the last year of the bond being in issue. Yeah.
Sawa. Thank you, guys. All right, so I think with that, we shall close the conversation. Of course, if you have any questions, we are here available to answer them for you. I think Wangui has put in our email. So if you're interested in the bond, just email us and we'll be able to assist with opening up your accounts and getting you started.
Hey Val, would you be okay if I asked one last question?
Yeah, sure. You guys, you'll buy me lunch one day.
So my question is, how can one benefit from Hazina if you already have a CDS account? If you've already done the opening process, what would that look like?
So the thing that now it helps you with, if you already have that sorted, is in case you need liquidity down the line, they offer that ability to buy the bond back for you. And it's much easier to go through them than to go through the secondary market. So maybe something that's not coming out clearly is that it can take months to sell a bond in the secondary market in Kenya. And especially if you're a retail investor, because a lot of the people who invest in bonds in Kenya, in the Kenyan market, are institutions. So they are buying these big chunks, they're buying 100 million, 50 million. So when you have your investment of 100K, 200K, $1 million shillings, it can get tricky to sell it. And someone like, but the guys at FIDA are now giving you, are providing the liquidity as a bank, but also they have a network of people who want to trade. So it's easier to do it through them.
Okay, thank you.
Okay, sawa. So I think any other questions, please share via email and we'll be happy to answer them for you. Have a great evening, guys.
Thanks
Thank you so much.
Thank you.